When we think of Japan, we think of flashing neon lights, busy downtown streets, the best of food, fashion, and culture. But here's what all that glitz and glamour is hiding: debt. Yup, Japan is now the most indebted country in the industrialized world as a result of years of stimulative, low-interest fiscal policy. But this crisis isn't anything new. In fact, it started in the early 1990s as the housing and stock market bubbles in Japan burst and the country's economy fell into recession. For the next 20 to 30 years, the government reduced taxes, expanded spending, and borrowed money to finance itself under catchy names like the Fiscal Structural Reform Act, emergency employment measures, and policy measures of economic rebirth. Pretty much all of it has been in vain. Join us as we take a look at the worrying rising debt crisis in Japan. As of September 2022, Japan's debt stands at a whopping $9.2 trillion. An expanding economy is necessary for a nation with mounting debt to overcome the load, right? Productivity and population increase are the two variables that drive economic growth. The problem is, even if productivity improvements continue to help the Japanese economy, population growth isn't on the cards. Every fourth person in Japan is 65 years of age or older, making it one of the developed world's oldest countries. It's a fact, the country's population is aging. In order to keep Japan's population at its current level, the people would have to up their baby game. While the average interest rate paid on the nation's debt decreased to 1.4% in 2009 from more than 6% in the 1990s, the severity of Japan's debt situation has been obscured by the fact that government spending on interest payments has remained constant over the previous 2 decades. In the past, the people of Japan have directly or indirectly absorbed more than 90% of the country's government-issued debt. However, Japan's savings rate, which was in the mid-teens in the 1990s, is now getting close to zero and is probably going to turn negative in the not-too-distant future. The Japanese economy is based on this false belief that the government would always be able to borrow money at low interest rates. In a more realistic scenario with far higher interest rates, the government will have to start hawking its debt outside of Japan as internal demand dwindles. Japan, which already leads the world in debt accumulation, added $2 trillion to its mountain of debt as a result of record stimulus spending to mitigate the effects of the coronavirus. Japan manages to maintain ultra-low government bond yields and great market confidence that it can avoid default, despite having debt levels that are around 2.5 times the size of its GDP. Regardless of your perspective, Japan's debt is unfathomably high. The Bank of Japan estimates that it was 1,328 trillion yen at the end of 2019. This is roughly comparable to $12.2 trillion, which is little over half of the total U.S. debt, but by far the largest pile when compared to the size of even Japan's robust economy. At the end of the 1990s, Japan's debt first crossed the 100% of GDP threshold due to stimulus measures and a fast-aging population that raised healthcare and social security costs. According to the International Monetary Fund, it reached 200% of GDP in 2010 and was made worse during the pandemic at around 250% until it came to the current levels of 266%. To put things into perspective for you, Greece's debt to GDP ratio is just 150% compared to the rest of Europe's burdened nations when it reached crisis point, whereas Spain's government has struggled with debt levels that are less than 100%. Even with extremely low interest rates, Japan's government still pays the second largest portion of its budget toward repayments due to the country's mounting debt. The only way to prevent adding to the backlog is to lower budget deficits by raising taxes or reducing government spending, but doing so runs the risk of stifling Japan's already recession-stricken economy's expansion. The BOJ's debt could be written off as a severe measure, but doing so would only be an accounting trick with no consequence on the real economy. However, this ignores the moral component of economic mechanisms. What laws apply to private investors and the state itself if we let states default on their debts? Increased taxes and the ensuing austerity measures, along with rising interest rates, would definitely further impede Japan's economy and push it towards insolvency. It's politically impossible for a country to default on its debt, particularly when the majority of that debt is owned by its own population. Japan, however, has total control over its currency printing machine, in contrast to European countries who socialized their currencies and are unable to create euros on their own. The hyperinflation that'll follow decades of deflation will obliterate the purchasing value of Japanese residents' savings and collapse their currency. Timing bubbles is highly challenging, and Japan is currently experiencing the late stages of a massive debt bubble. They typically survive longer than what reasonable observers anticipate. But if Japan's debt climbs further, the eventual bubble explosion becomes more disastrous. Japan serves as evidence that a nation cannot borrow its way to prosperity. The United States and other wealthy countries still have a chance to make the morally right but politically challenging choice to reduce fiscal spending and cease depending on the government for sustainable growth, which it never is. The general opinion regarding Japan has not changed, despite variations in predictions of the timing. The third largest economy in the world may start to run out of the savings needed to pay off its enormous public debt in just 3 to 10 years. Is it time to start selling in, or are the gloomy predictions about the biggest creditor nation in the world inaccurate? The time when Tokyo's finance officials were praised for their fiscal restraint is long gone. The public debt to GDP ratio is anticipated to reach 300% of GDP by 2030, with minor budgetary changes, with additional cutbacks thought necessary to stabilize and then start reducing the ratio. It's predicted that an additional 5 to 6% increase in the consumption tax will be needed to reach the primary balance where fiscal expenses can be paid for without resorting to borrowing. The agricultural, electrical, and service industries, as well as the politically delicate actions of joining the Trans-Pacific Partnership and increasing immigration, have all been proposed as remedies to Japan's economic problems. The IMF has recommended that in order to achieve fiscal consolidation, the consumption tax rate be increased to 15%, corporation taxes be decreased, the personal income tax base be expanded, and the pension retirement age be raised to 67. As spending growth outpaced economic expansion, a gauge of Japan's government debt increased to a record high level of about 994 trillion yen in September. The total amount of outstanding general government bonds, which includes borrowing to pay for deficits or fund public works, increased by 9.46 trillion yen. In response to people and some businesses feeling the effects of a weak yen, the government launched an economic package worth nearly $200 billion to help temper the greatest inflation seen in decades. The plan was unveiled by Prime Minister Fumio Kishida, who also stressed the importance of focusing on energy prices, which he claimed are the primary cause of the price increase. Kishida said his government would protect people's livelihoods from high prices through effective and drastic easing measures. But get this, the economic package will further add to Japan's debt. The most recent stimulus spending served as a reminder of the challenges Kishida's administration faces in attaining economic growth while enacting fiscal reform, making Japan an outlier in a global trend to scale back crisis mode stimulus policy. According to the Japanese Ministry of Finance, an extra 22.8 trillion yen in new debt would be issued to help pay for the most recent supplementary budget, bringing the total amount of new borrowing anticipated for this fiscal year to 62.5 trillion yen. The additional spending included measures to assist households in coping with rising power, gas, and gasoline prices. It also attempted to assist diverse locations in luring tourists by utilizing the depreciating yen. Also, they allocated funds for an unplanned budgetary reserve. To a record 68.4 trillion yen, the government has increased its projected tax receipts by 3.1 trillion yen. Some of the budgetary shortfall would be filled with leftover money from the previous year. While most other major economies are adopting anti-inflationary measures, Japan has chosen to provide stimulus. The most recent actions increased this fiscal year's total budgeted spending to above 139.2 trillion yen. Only time will tell how this will fare for the land of the rising debt. Thanks for watching. Let us know what your predictions for Japan are. And if you liked what you saw, check out this video on our channel next.